Disclaimer.
It's 9:00 a.m. this Tuesday, January 20th, 2026, and the silver market has just entered a war zone. While the COMEX was frozen this weekend, physical prices in Dubai exploded to a record $130 gap over paper. This isn't just a rally, it's a total decoupling. But be warned, if you aren't prepared, the IRS is positioned to seize 50% of your gains at the opening bell. Stay tuned, here's what the banks are hiding from you. This morning, as you're reading this on Tuesday, January 20th, 2026, silver hit an all-time record high of $94.73 per ounce. You might think that's incredible news if you've been holding physical silver for your retirement. Here's what the headlines won't tell you. For most Americans over 55, this isn't a windfall moment. It's a trapdoor opening beneath your feet. And the IRS is standing right there with a collection bag, ready to seize nearly half of everything you thought you'd gained. Pop quiz. What happens when you finally decide to sell that silver you've been stacking for 20 years? You probably think you'll pay the same capital gains rate as your neighbor who just cashed out his Apple stock at 15%. Think again. The moment you walk into that coin shop or process that online sale, you've just triggered a tax code specifically designed to treat your life savings like baseball cards or vintage wine, what the government calls a collectible. That classification alone pushes your federal tax rate to 28%. And we haven't even started adding state taxes or the additional 3.8% net investment income tax that kicks in for higher earners. Let's do the math on a real scenario. Say you bought 500 ounces of silver back in 2020 at 18 per ounce. That's a $9,000 investment. At this morning's $94.73 price, you're sitting on $47,165 worth of metal, which looks like a $38,365 gain on paper. Your neighbor sells $47,265 worth of Tesla stock with the same gain and pays 15% to federal capital gains, walking away with $32,610 after taxes. You sell your silver, and the IRS hits you with 28% federal, plus, let's say, 5% state tax, plus that 3.8% NIT if you're in the higher brackets. You're looking at a combined rate pushing 37%. Which means you're handing over $1,495 in taxes and keeping just $24,107 of your gains. That's $8,440 less than your neighbor for making the exact same smart investment decision. The only difference is what you invested in. Here's where it gets interesting. While you were enjoying the long Martin Luther King Jr. weekend, something unprecedented happened in the global silver market. From Friday, January 17th through Monday morning, January 20th, the physical silver market effectively went dark for 72 hours. Most Americans assumed it was just a holiday weekend. Markets closed, nothing unusual. But if you were watching the trading screens in Shanghai, Singapore, and Dubai, you witnessed something that has not happened in modern commodity history. A complete decoupling between paper silver prices and actual physical metal. During those 72 hours, President Trump escalated his Greenland sovereignty dispute into what traders are now calling the Greenland Tariff crisis. 8 European nations that had questioned American claims in the Arctic suddenly found themselves facing threats of 25% tariffs on all goods entering the United States. What does Greenland have to do with your silver holdings? Everything, because those 8 nations control the primary shipping routes and refining infrastructure that move physical silver from mines to vaults to your local dealer. According to shipping manifests reviewed by metals analysts over the weekend, at least 17 cargo vessels carrying refined silver simply stopped in international waters, waiting for clarity on whether their shipments would face these new tariffs. The captains weren't being dramatic, they were doing math. A 25% tariff on a container of silver worth $4 million means an instant $1 million penalty. So they waited, floating in the Atlantic and the North Sea, while the digital trading platforms showed silver prices that had absolutely nothing to do with the reality of metal you could actually touch and store. When Asian markets opened on Monday morning, their time, still Sunday evening in New York, physical silver premiums in Shanghai exploded to $40 over spot price. That's the difference between the paper price and what you actually have to pay to get real metal delivered to your vault. By Monday afternoon in Singapore, dealers were quoting $135 per ounce for immediate delivery of standard silver bars. Let me put that in perspective. While the official COMEX price showed $89, people with actual money were paying $135 to secure physical silver they could hold in their hands. You might be wondering why this premium surge matters to you. Here's the cruel irony. When the COMEX reopened this morning, Tuesday, January 20th, the official price jumped to $94.73, and that's the number the IRS will use to calculate your tax bill. But try to actually sell your silver today right now, and you'll discover that buyers are offering you $88 to $90 per ounce, below the official price, because they know the premium collapse is coming as those cargo ships start moving again. You're about to pay taxes on a $94 price while receiving an $88 payout. This isn't a conspiracy theory or internet speculation. The Bank for International Settlements, which basically serves as the central bank for central banks, published data last week showing that paper silver contracts outstanding now represent 340 days of global mine production. That means if everyone who owns a silver contract decided they wanted actual delivery instead of cash settlement, the system would need almost a full year of every silver mine on Earth, producing at maximum capacity just to fulfill existing obligations. We're not talking about a supply squeeze. We're talking about a mathematical impossibility that's been hiding in plain sight. Have you noticed what's been happening to electronics prices lately? Your new smartphone, your laptop, even the solar panels your neighbor just installed. All of them require silver for their circuitry and photovoltaic cells. According to the Silver Institute's January 2026 report, industrial demand for silver in the artificial intelligence sector alone has increased by 47% over the past 18 months. Data centers running AI models need silver-based components that can handle massive electrical loads without degrading. Electric vehicle manufacturers are consuming silver at rates that would have seemed impossible just 5 years ago. These aren't jewelry makers or coin collectors we're talking about. These are massive tech companies that need physical silver delivered to factories in Shenzhen, Austin, and Munich. And they are discovering that the silver market they thought was deep and liquid is actually shockingly shallow when you need truckloads instead of paper contracts. Here's what should grab your attention. While you were accumulating silver as a retirement hedge against inflation and currency instability, the tax code was lying in wait with a designation that categorizes your strategic metal holdings, the same way it treats your kid's Pokemon card collection. The government didn't need to confiscate your silver. They just needed to wait for a price spike, like the one we're seeing this morning, then step in with a tax bill so large that you will hand over half your gains voluntarily just to settle your obligation. Think about the timing for a moment. You bought silver at 18 eyes an ounce back in 2020 when the world was shutting down and the Federal Reserve was printing trillions. You watched it climb to $30, then $50, then $70 over the past few years. This morning it finally crossed $90, and you're thinking about retirement, about paying off that mortgage, about actually converting your foresight into financial security. But that 72-hour blackout has revealed something the establishment desperately hoped you wouldn't notice. The system is already broken. And your record gains are just the bait in a trap designed to extract maximum taxation before the real crisis hits. The cargo ships are starting to move again. As I'm recording this, European nations are scrambling to negotiate with the Trump administration. The COMEX is processing orders and dealers are updating their quotes by the hour. But for Americans holding physical silver in their homes, in their safe deposit boxes, or in their non-retirement brokerage accounts, the clock is now ticking on a tax obligation that could consume half of everything they thought they'd earned by being smart enough to buy silver when it was cheap. Now let's talk about the legal framework that makes this tax seizure not just possible, but virtually guaranteed the moment you decide to liquidate your silver holdings. The key to understanding how deeply this trap has been set lies in a relatively obscure section of the Internal Revenue Code that most financial advisors either don't know about or conveniently forget to mention when they're selling you precious metals for your retirement portfolio. Internal Revenue Code. Section 408M is the weapon the IRS has been holding in reserve, waiting for exactly this moment. This statute explicitly defines what qualifies as a collectible for tax purposes, and the list reads like it was designed by someone who wanted to punish people for protecting themselves against currency debasement. We're talking about artwork, rugs, antiques, metals, gems, stamps, coins, and alcoholic beverages all grouped together in the same category. Your physical gold and silver bars sit in the exact same tax bracket as a vintage wine collection or a rare baseball card. The implication is clear. The government views your strategic decision to hold physical precious metals as a hobby, not as a legitimate investment strategy. What makes this particularly insidious is the specific tax rate structure that kicks in once you're classified under Section 408M. While your colleagues, who invested in traditional stocks, bonds, or real estate, get to enjoy the preferential long-term capital gains rate of 15% or 20% depending on their income bracket, you're immediately pushed into a maximum federal rate of 28% on your precious metals gains. But that's just the federal component, and this is where the math becomes truly punishing for anyone who thought they were making a smart financial move. Let's build out the complete tax picture that hits you the moment you sell. Start with that 28% federal collectibles rate. That's the floor, not the ceiling. If you live in California, you're adding 13.3% state tax on top. New York residents are looking at an additional 10.9%. Even if you're in a more tax-friendly state like Texas or Florida with no state income tax, you're still not done with the calculations. The net investment income tax, which was introduced as part of the Affordable Care Act, adds another 3.8% for individuals earning over $200,000 or couples filing jointly above $250,000. When you stack these rates together, you're looking at effective tax rates between 31.8% and 45.1%, depending on where you live and what you earn. That's not a tax. That's a confiscation dressed up in legal language. Here's what makes this timing so critical. According to IRS publication 590B, the agency is very specific about when these taxes are owed and what documentation is required. Any dealer who buys more than $1,000 worth of silver bars from you in a single transaction is required to file Form 1099-B with the IRS, creating a permanent digital record of your sale. There's no hiding this transaction, no deferring the tax bill, no creative accounting that makes it disappear. The moment that form gets filed, the clock starts ticking on your tax obligation, and the IRS has 3 years to audit your return if they suspect you've underreported. Now let's shift our focus to what's been happening in the physical silver market while most Americans were watching stock prices and Bitcoin charts. On January 1st, 2026, the Chinese government implemented what trade analysts are calling the most significant restructuring of the global silver supply chain in modern history. The new regulations mandate that 70% of all refined silver moving through Chinese territory, which effectively means 70% of the world's total refined silver production, must now flow through a licensed-only export system. Think about what that actually means in practical terms. China doesn't just mine silver. They refine the raw ore from mines in Peru, Mexico, Australia, and dozens of other countries, transforming it into the standardized bars and industrial-grade material that manufacturers need. By controlling the refining bottleneck and implementing this licensing system, Beijing has effectively created a choke point on global silver supply that they can tighten or loosen based on their strategic interests. And here's the kicker. As of this morning, there are only 44 authorized exporters in the entire Chinese system who are legally permitted to move refined silver across international borders. Let me put that number in perspective. 44 companies now control the flow of 70% of the world's refined silver. That's not a free market. That's a cartel operating with government backing. These aren't small mom-and-pop operations either. According to trade data from Chinese customs authorities, the average authorized exporter is moving between 800 and 1,200 metric tons of silver per year, which means each one of these 44 companies has more control over global silver supply than entire national governments did just 5 years ago. The implications for American silver holders become clear when you look at what's been happening at the COMEX, which is supposed to be the primary price discovery mechanism for silver in the Western world. Registered silver stocks at COMEX warehouses, that's the metal that's actually available for delivery to settle futures contracts, have collapsed by 70% since 2020. We're not talking about a gradual decline here. In January 2020, COMEX warehouses held approximately 150 million ounces of registered silver. As of last Friday's warehouse report, that number had fallen to roughly 45 million ounces. Here's where the story gets really interesting. Earlier this month, specifically during the first week of January 2026, Bloomberg terminals showed approximately $6.8 billion worth of paper silver being dumped onto the futures market for what the financial press described as index rebalancing. Pension funds and commodity index funds that had overweighted their silver exposure were supposedly selling down their positions to get back to their target allocations. In normal market conditions, when you see nearly $7 billion worth of selling pressure hit a market in a matter of days, you expect prices to crater. That's basic supply and demand. But something unprecedented happened. The price didn't crash. In fact, silver barely budged during that selling wave, dropping only about 2 per ounce before stabilizing and then continuing its climb toward the $94 level we saw this morning. The traditional relationship between selling pressure and price movement had completely broken down, and the mainstream financial media seemed utterly confused about why their models weren't working anymore. The answer lies in what's been happening behind the scenes at the industrial level. Major technology companies, solar panel manufacturers, and defense contractors have stopped relying on the COMEX futures market to secure their silver supply. Instead, they've been going directly to vault holders and negotiating off-market purchases of physical metal with immediate delivery requirements. These aren't speculators placing bets on price movements. These are companies that need actual silver delivered to their facilities by specific dates to keep production lines running. Data from the Silver Institute shows that photovoltaic cell production alone consumed 140 million ounces of silver in 2025, and that number is projected to exceed 180 million ounces in 2026 as solar adoption accelerates globally. The electric vehicle sector added another 55 million ounces of demand, while AI data center construction required approximately 30 million ounces for high-performance computing components. When you add up industrial demand across all sectors, you're looking at consumption that exceeds annual mine production by a significant margin, which means the deficit has to be made up either from above-ground stockpiles or recycled material. But here's the problem. Recycling silver from old electronics and industrial waste is expensive and time-consuming, often costing more per ounce than simply buying newly mined material. And those above-ground stockpiles we just discussed, they're shrinking rapidly, locked up in vaults by entities who have figured out that physical silver is becoming genuinely scarce at the exact moment industrial demand is exploding. According to The World Silver Survey published last month, total identifiable silver inventories across all global exchanges, ETFs, and reported stockpiles stood at approximately 2.1 billion ounces at the end of 2025. That sounds like a lot until you realize that at current industrial consumption rates, that entire stockpile represents less than 2 years of supply if mining production were to completely stop. And unlike gold, which gets hoarded and recycled at very high rates, silver gets consumed in industrial applications, where it's often too expensive to recover and reuse. The Chinese licensing system we discussed earlier has created an additional complication that most silver investors haven't fully grasped yet. Because 70% of refined silver now flows through those 44 authorized exporters, any geopolitical tension between China and the West creates immediate supply disruptions that the COMEX futures market is structurally incapable of resolving. You can sell all the paper contracts you want, but if the physical metal is sitting in a Shanghai warehouse waiting for an export license that may or may not be approved, those paper contracts become increasingly disconnected from reality. This is exactly what we witnessed during the 72-hour blackout over the MLK weekend. When President Trump's Greenland Tariff threats introduced uncertainty about European shipping routes, and when Chinese exporters weren't processing orders due to their own holiday schedules, the physical premium in Asian markets exploded to that $130 level we mentioned earlier. The paper price on COMEX showed one number, but if you actually needed physical silver delivered to your vault in Dubai or Singapore, you were paying a completely different, much higher price for the same metal. For American investors holding physical silver in their possession or in domestic storage facilities, this global supply chain restructuring creates a scenario where your metal is simultaneously more valuable in terms of real purchasing power, but potentially more difficult to liquidate at fair prices. The local coin dealers and bullion exchanges that most retail investors rely on for selling their holdings are themselves struggling to source new inventory at reasonable premiums, which means they're lowering the prices they're willing to pay for your metal even as the official spot price climbs higher. Let us get into the numbers that Wall Street does not want you calculating on your own, because once you see the math, you'll understand why this morning's 94 price is on a peak. It's actually a significant undervaluation based on the new tariff reality that's being imposed on global silver trade. What we're about to walk through is the hard mathematical floor that's being constructed beneath the silver market, and it has nothing to do with speculation or market sentiment. This is pure arithmetic based on policy decisions that are already in motion. President Trump's tariff threats aren't just negotiating tactics or political theater. According to statements from the Office of the United States Trade Representative published last week, the administration is preparing to implement a 25% tariff on certain categories of imported goods, with refined precious metals specifically mentioned as potential targets if trade negotiations with key European and Asian partners don't produce favorable outcomes by June 2026. That's not a hypothetical scenario anymore. That's official policy direction with a clear timeline. Now let's do the tariff math and see what it means for silver pricing. Current production costs for mining and refining silver, according to the most recent data from the Silver Institute, average approximately $21 per ounce when you account for all-in sustaining costs across major mining operations globally. That's your baseline, the actual cost to pull silver out of the ground, refine it to the standard purity levels that industrial users require, and transport it to major trading hubs. Add in profit margins for mining companies, which typically run between 15% and 25% depending on operational efficiency, and you're looking at a break-even market price around $20 to $26 per ounce under normal conditions. But we're not operating under normal conditions anymore. If the Trump administration follows through with its 25% tariff on imported refined silver, you need to add that percentage on top of the production cost and profit margin structure. Here's where the calculation becomes critical. A 25% tariff doesn't just add 25% to the current spot price. It adds 25% to the entire cost structure, including shipping, insurance, handling, and dealer markups that occur between the refinery and the end user. Industry analysts at Metals Focus, one of the leading precious metals research firms, published calculations last week showing that when you factor in typical supply chain costs and apply a 25% tariff at the import stage, The break-even price for international silver trade into the United States jumps to $112.42 per ounce. Let me repeat that number because it's the most important figure in this entire discussion. 112.42 is the mathematical floor below, which international silver trade simply stops making economic sense once the tariffs are implemented. What does that mean for the $94.73 price we saw this morning? It means that silver is currently trading $17.69 below its tariff-adjusted break-even level. That's not a small gap. That's nearly a 19% discount from where the price needs to be for the global silver market to function normally under the new tariff regime. And here's the crucial point. This isn't about predicting where prices might go based on supply and demand dynamics. This is about a hard mathematical floor being constructed by policy decisions that are already documented and scheduled for implementation. The international silver trade can't operate at a loss indefinitely. Mining companies can shut down operations. Refineries can pause production, and exporters can simply refuse to ship silver into the United States if the tariffs make transactions unprofitable. We've already seen the beginning of this dynamic during the 72-hour blackout when cargo ships stopped in international waters, waiting for clarity on the tariff situation. Those captains weren't being dramatic. They were running the exact same calculation we just walked through, and realizing that delivering their cargo might result in financial losses that no shipping company can afford to absorb. Now let's talk about the two legal pathways that exist for American silver holders to navigate this tax trap without handing over half their gains to the IRS. These are not loopholes in the traditional sense. They are legitimate structures built into existing law that most people simply don't know about. Because the financial services industry makes more money selling you conventional products than helping you minimize your tax burden. The first pathway involves understanding a critical distinction in how different forms of physical silver are treated for reporting purposes. This is where the American Silver Eagle coin becomes your most important asset. And the reason has everything to do with its legal tender status under United States Code Title 31. Section 581.12, this federal statute establishes that American Eagle coins, both gold and silver versions, are official legal tender of the United States with face values denominated in dollars. Now, you might be thinking that a silver coin with a $1 face value that is worth $94 in silver content seems like a strange concept, and you're absolutely right. But that legal tender designation creates a unique reporting situation that dramatically affects your privacy and tax planning options. According to IRS regulations and industry reporting requirements established by the Financial Crimes Enforcement Network, precious metals dealers are required to file Form 1099-B for certain types of silver sales that exceed specific thresholds. Here's where it gets interesting. 1 kilogram silver bars, which are extremely popular among investors, because of their relatively low premiums over spot price, trigger mandatory 1099-B reporting at any quantity when sold back to dealers. The moment you walk into a coin shop and sell even a single 1 kilo bar, the dealer is legally required to collect your social security number, verify your identity, and file a 1099-B with the IRS reporting the transaction. That form creates an immediate digital trail that the agency can use to verify your tax reporting and initiate audits if they suspect discrepancies. American Silver Eagles, on the other hand, fall into a different reporting category because of their legal tender status. Dealers are not required to file 1099-B forms for American Eagle sales unless the transaction involves 1,000 ounces or more in a single sale. That's not 1,000 coins, that's 1,000 troy ounces total, which works out to exactly 1,001 ounce Silver Eagles. For the vast majority of individual investors, selling quantities below 1,000 ounces means no automatic 1099-B filing, which provides a significant privacy advantage when it comes to managing your tax reporting timeline and strategy. Let's be very clear about what this means in practical terms. You still owe taxes on your capital gains regardless of whether a 1099-B gets filed. The IRS doesn't need a dealer report to expect you to report your investment income. That's your legal obligation as a taxpayer. But the absence of an automatic 1099-B gives you more flexibility in how you structure your sales, potentially spreading them across multiple tax years to manage your bracket positioning, or coordinating sales with years where you have capital losses from other investments that can offset your silver gains. The privacy advantage also matters in a different way that most people don't consider until it's too late. Once the IRS receives a 1099-B showing you sold silver, that information gets fed into their computer systems, which can trigger automated matching programs that compare dealer reports against your filed tax returns. If there's any discrepancy, maybe you miscalculated your cost basis, or you forgot to report a transaction from years earlier, the IRS now has concrete documentation to initiate an audit. With American Eagles under the reporting threshold, you maintain control over the documentation and timing of your tax reporting, which gives you more room to work with tax professionals to optimize your strategy. But here's the reality check. Even with the American Eagle reporting advantage, you're still facing that 28% federal collectibles rate plus state taxes and NIIT if you sell silver held in a regular taxable account. The privacy benefits matter, the reporting flexibility helps, but you're still ultimately handing over somewhere between 32% and 45% of your gains depending on where you live and what you earn. That is where the second pathway becomes absolutely critical for anyone serious about protecting their silver gains from IRS seizure. The Self-Directed Roth IRA represents the only legal structure currently available under U.S. tax law that allows you to hold physical precious metals while completely eliminating the collectibles tax burden. Let me emphasize that point, completely eliminating, not deferring or reducing. When you hold silver inside a properly structured self-directed Roth IRA, your gains are 100% tax-free upon withdrawal, regardless of how high the price climbs or how long you hold the metal. Here's how the structure works. Roth IRAs operate under a completely different tax framework. You contribute after-tax dollars without getting an upfront deduction, but in exchange, all future growth and all future withdrawals are completely tax-free as long as you follow the distribution rules. According to IRS publication 590.A, which governs IRA regulations, there is no limit on what types of investments a Roth IRA can hold as long as you use a qualified custodian and follow the prohibited transaction rules. Most banks and brokerage firms that offer Roth IRAs limit your investment options to their own product menus. Mutual fund, stocks, bonds, maybe some ETFs. They make money from management fees and trading commissions, so they have zero incentive to tell you that you can actually hold physical gold and silver bars in your Roth IRA. But the law is very clear. IRS regulations specifically allow IRAs to hold precious metals as long as they meet certain fineness requirements and are held by an approved depository rather than in your personal possession. This is where self-directed IRA custodians come in. These specialized financial institutions are specifically set up to handle alternative assets, including real estate, private equity, and precious metals within IRA accounts. You open a self-directed Roth IRA with an approved custodian transfer funds into the account either through new contributions or by rolling over existing retirement accounts, and then direct the custodian to purchase physical silver on behalf of your Roth IRA. The metal gets stored in an IRS-approved depository in your IRA's name, and all the gains that accumulate as silver prices rise are sheltered inside that Roth structure. When you eventually take distributions in retirement, assuming you've met the 5-year holding requirement and you're over 59 and a half years old, every dollar comes out completely tax-free. That 28% federal collectibles rate, gone. State income taxes on your gains, eliminated. The 3.8% net investment income tax doesn't apply. You've converted what would have been a 40-45% combined tax hit into a 0% rate, which means you keep 100% of your gains instead of watching half of them disappear into government coffers. Let's run the numbers on what this actually means using our earlier example. Remember that scenario where you bought 500 ounces at $18 and sold at $94.73, generating a $38,365 gain? In a taxable account with a collectibles tax structure, you were looking at keeping roughly $24,170 after taxes. In a self-directed Roth IRA, you keep the entire $38,365 gain. That's an extra $14,195 in your pocket. Real money that can fund years of retirement expenses or get passed to your heirs completely tax-free. The critical timing element here is that you need to get your silver into the Roth structure before you sell it. You can't sell silver held in a taxable account, realize the gains pay the taxes, and then try to move the proceeds into a Roth. The IRS has annual contribution limits on Roth IRAs that would make that strategy impossible for any significant silver position. The time to act is now, while your silver is still unsold and while you can structure a transfer that moves the physical metal directly from your personal holdings into your self-directed Roth IRA through a contribution or rollover transaction. This morning's $94 price, with the understanding that tariff math creates a floor at $112.42, means you're looking at a potential 19% gain just from the policy-driven price adjustment that's coming over the next few months. If you capture that move inside a Roth IRA structure, that entire 19% compounds tax-free. If you capture it in a taxable account, you're handing over 40 to 45% of that gain to various government entities, which turns your 19% gross return into a 10-11% net return after taxes. The stakes have never been higher, and the mathematics have never been clearer. Our country is entering a period where the silver market is being fundamentally restructured by tariff policy, Chinese export controls, and industrial demand that exceeds available supply. The investors who understand these dynamics and position themselves accordingly will preserve their wealth. Those who ignore the tax implications and the supply chain realities will watch their paper gains evaporate into IRS payments and unfavorable liquidation prices. The choice is yours, and the clock is ticking.